Welcome to another edition of the Chicks on the Right podcast, where bi-weekly we talk to our good friend, Zach Abraham from Bulwark Capital Management. And we're very, very excited to talk to him about a couple things today, namely the first one being this impending government shutdown, which I have said on our show, I've just kind of stopped caring about it. And I don't know, I know Daisy kind of feels the same way, where we're we're over it.
Well, I mean, it would be great if we could just shut it down and not pay them. That would be fantastic. That the only thing that bothers me is if we shut it down, we still have to pay these yahoos, but that's not the utopia that I would like. So
yeah.
Right.
The politicians get paid, not the people that actually do the work, right?
Right, exactly. I would like it, that's a good correction, Zach. Like, I would like it if the politicians don't get paid, because what do they do? What exactly do you do here?
Yeah. So just really quick, the budgets, the debt ceiling talk, right? The government shutdown talk, all of that to me goes in the same category, because it's just kabuki theater by nature, right? It's just political theater. They will not continue to do that, and it'll be short-lived, and it doesn't matter.
Right.
Okay. So we're right. We're right.
So we don't really have to worry about it. Okay. All right. So we'll talk about something that matters. Let's talk about something that matters.
Yeah. Like, what is going on with the real estate market? What is happening? I know lots and lots of people are confused and worried and concerned, and give us the real dirty.
Yeah. So we pay attention to it really closely, because real estate is still a very big part of the economy. The part about it that interests us the most right now is that when you look at one of the things that we watch on a regular basis is something that we call LEIs, leading economic indicators. And they can be leading a certain way, that nothing has 100% accuracy, but you put enough of them together and it gives you a really good idea of the trajectory of an economy. And really pretty much every leading economic indicator has broken down and is pointing straight at recessionary levels. Not there yet, but certainly pointing there and heading that way at a decent clip. The one leg of the stool that's still in place that everybody keeps resting their hat on is the labor market. And when you watch unemployment start to move higher, that's usually the last part, right? That's the last thing that rolls over going into a recession. And housing construction jobs, or construction jobs in general, are the leading edge of those job losses. So when you start to see construction jobs roll over, you're like, okay, we're getting really close, right? So for all those reasons, we keep a very good eye on housing. And pretty much nationwide, volumes of home sales have dropped by, I think we're at like a 27-year low. We're 27-year low on mortgages. Maybe housing's not quite, maybe actual home sales aren't quite that much, but we're 45 to 50% off of our normal housing volumes, right? So huge reduction, bigger reduction than we saw in the financial crisis in terms of homes being sold. Well, there's an old adage in the investment world, which is price follows volume. All right. And it's true of any market, meaning when volume, or the amount of things trading, drops significantly on a market and price hasn't dropped yet, wait, because it's going to. Okay, because bottom line, right? What is it telling you? It's telling you that you have less demand, right? So keeping an eye on housing, you get all these reports, everything's going down. We monitor several different markets. Our estimates are that nationwide, you're probably down 12 to 15% from the absolute COVID peak. But to put it in context, we're still well above where we were in January 1 of 2020. So This isn't some disaster. But then you hear the real estate news, housing strength and price strength. And median home prices have actually risen over the last 4 years. And I couldn't help but laughing when I was reading an article that was saying this the other day. So we actually dug into it. First of all, we need to understand that median and average are two different things, right? Average, we take a bunch of things together, we add them up, and then we divide them by the number. So the number of things we're counting has a very large part in what an average is, right? So with median, it doesn't work that way. If we want to know what the median price of a house is, let's say we've got 100 homes that have sold in a zip code, right? We organize the 100 homes from least expensive to most expensive, and number 50 is the median home price. Okay, so what do we know about this real estate meltdown, if you will, or issue that is really not normal in terms of history? The one thing we know that is not normal, that is, as a matter of fact, opposite of normal, is that the lower end, so let's say houses under 700,000, the volumes in that range have dried up substantially more than homes above that, which makes perfect sense, right? People that are shopping for homes above that level, a much larger percentage of those folks will pay with cash. They don't need to access credit, right? A very small percentage of people under 700,000 need or can pay with cash, right? So it's the inverse. Usually the higher end gets hit the hardest by far. And, that was true in the Great Recession. It's been true of every recession. Well, this is inverse. Okay, so let's say, and these are close to norms. You can kind of look at it several different ways, but let's make that $750,000 level. Let's make that demarcation, right? And the reason I picked that is 80% of mortgages, the jumbo mortgage market right now starts at $726,000. Okay. So everything below that is not considered a jumbo mortgage, and jumbo mortgages make up about 20% of mortgages issued. Okay. Wow. So let's say that number is relatively close, which it is in terms of home prices. The homes that sell in that price. So right now, though, you have volumes getting killed on the lower side. So we think that mix right now, and when I say we think, we know it's somewhere in this range just by crunching the math and looking at the data, that mix is now somewhere between, let's say, 50-50 and maybe even 40-60. So 40% of volumes being sold below 726,000, 60% above, a complete break from historical norms. Okay, well, when you have such a swing like that in the types of homes that you're looking at, you can easily have a scenario, and this is what we're dealing with right now, where all home prices are down 15 to 20%. But because the mix is no longer 80-20 in the sample pool, right? It's 50-50, the median home price is actually higher, right? Does that make sense to you guys? Mm-hmm. So let's say houses don't even change in price. If half of the homes we list are below 750 and half are above 750, the median price by definition is going to be higher than if we sample 80% of homes under 750, right? Yeah. So it's what we call a fallacy of composition, meaning the reason it's showing a gain is actually illustrating the problem in the real estate market, and it's not good news. That we back that up by looking at major markets in Seattle, San Francisco, LA, Phoenix, certain cities in Texas, looking up and down the East Coast. Universally, you're right around 12 to 15, some a little less, some a little more. And we've just hit a peak in mortgages. So we'd expect housing activity to continue to decelerate as long as mortgages rise. But this myth out there that housing is holding up, it's not. And it won't as long as rates are anywhere close to this level.
Huh. So what do you think is does the shutdown impact rates? Does it have anything to do with it? Do you expect rates to change over the next, 1 to 2 years? Does it all depend on the election? What should people be thinking?
Yeah, well, look, like every economic forecast, we can be wrong. We just admit it. Right. So a lot of people don't. But I think the easiest way to look at this and to keep this in mind, and by the way, guys, we see this being played back in the economy right now. We just got banking information out. Now, don't quote me. It's from my analyst, and I don't have the notes right in front of me. But it's either year over year or month over month. Debit card transactions from banks are down 6%. That was the recent data that came out, which corresponds to about a 2% pullback in consumer spending. So excess savings rates are back below where they were prior to COVID. Okay, so we think all these slowdowns are happening right now. Well, traditionally, what happens when the Fed wants to take on inflation or the fear of higher inflation, historically speaking, they almost always go too high. They break something, right? And then they realize the issue too late. Kind of think back to 08, 09, right? We had guys in the financial industry screaming, hey, you're about ready to blow up the entire world. And the Fed's like, well, we're worried about inflation, right? And then they pivot late and usually cut too much. So I don't see any reason why that won't be the case. I think that you're going to see I think the recession will be visible. We're looking at the timing right now. It could be a little sticky, but I think we're going to see recession visible by Q1 or Q2 of next year. As soon as that happens, the Fed will start cutting rates and rates will be down. I will be shocked if money market accounts, Fed funds rate are not down 100. Well, maybe not the Fed funds rate. I will be shocked if mortgage rates aren't down 2.5% to 3.5% by the end of next year.
This will be great for you. This will be great.
That would
for
be
Mock.
great for me.
Yes. Well, here's the trick, right? And this is one of the things we talk to our clients all about risk management. If you don't get hammered in a downturn, right? If we can conserve cash in a downturn, then downturns are actually opportunities. We're not happy that other people are struggling, but we try to encourage our clients to think opposite, right? We want to be fearful when everybody else is greedy, and then we want to wait until everybody else needs to sell things and we get to buy them at discounts. I think the same is going to be true of rates. How low will they go? It's hard to say, but the easy way to think about this, guys, is that when you spend 15 years stacking up the world's largest pile of debt in history at the world's lowest interest rates in history, and then you jack those rates 550% in 18 months, things are going to implode. Okay,
Isn't it crazy though? Like if you look at house prices back in the 70s and 80s, houses were affordable. Like I think it's in 1974, a house costs
40 grand.
Well, yeah. I mean, it's a house costs what, 2 years of somebody's salary, average salary.
Right.
It's that's what it costs in the 70s. Somebody could freaking afford a house. I'm not saying you could pay it off in 2 years, but I mean, it was you looked at it and you thought, okay, this is reasonable. I can pay this off. And I could pay it off in 6 years if I wanted to, if I actually just managed my money well. Now, but the interest rate was 14% or something. I don't even know. I'm ballparking there.
It was a lot.
Now, right, it was double digits. And then they dropped the interest rates over the years, and it's it became this thing where interest rates are so low, and then the house prices are so freaking high.
Yeah, and this is why we have the term financial repression. It's why a lot of people, rightfully so, refer to record low interest rates and extreme monetary policy, is what we call it in economic terms, right? It's why a lot of really well-respected people and a lot of really smart people say that, look, when you do that with interest rates, it's actually a wealth transfer from the poor to the rich. And why is that? Because who owns all the assets? Rich people. Mm-hmm. You drive asset prices way up due to low interest rates, right?
Yeah.
And those people have to purchase those assets. And eventually inflation shows up, rates go up, and those people are up a creek without a paddle.
Yeah.
Right. And so that's you pay a price for what we've done for the last 15 years, despite the Fed thinking there won't be one. There will be, and more things are going to break. And we got an early salvo this year in March. Think about what's going on in markets and think about how glowingly everybody talks about the economy right now. You were literally weeks away from a national bank run on regional banks back in March. Okay, that's not because everything's good. That's not because everything's healthy. It is crazy to me, the level of disconnect that people, politicians, everybody has to what's on the economic horizon. And like I've said to you guys, is it 08, 09? No, it's not an issue like that. But we're clearly going into recession, and it'll be the first recession in the history of our country where lower interest rates or cutting interest rates really doesn't help, because we had interest rates at zero for 15 years.
Yeah.
Well, and this is why people really need to make sure that they're tuning in to our discussion every couple of weeks, because you just proved it. Reporters are reporting just these stats without any of the context, and the context is really important. We know important. We can always count on you to give it, and so we very, very much appreciate it. How can people learn more about you and Bulwark Capital Management?
Yeah, well, thank you for your kind words, first of all. But I think the easiest way to do it is you can just Google us, Know Your Risk Radio. We have a radio show that airs once a week. And then I've told you guys this before, but I think that we're in an incredibly unique, historic spot. And so we've actually started doing a 12 to 15 minute segment every single day, documenting what happened that day in markets and the economy. And that's called our Daily Dots. It's all part of our Know Your Risk Radio podcast. You can find it on iTunes, Spotify, right? Anywhere there's a podcast site, you can find us on there, or you can just go to bulwarkcapitalmanagement.com. We're not tough to find.
How long is it,
All
Zach?
right.
How long is the daily? Just curious. Is it like a kind of like a quick like punch list of everything that's going on?
Yeah, we try to keep it between 12 to 15. Anytime
Okay.
the Fed comes out and speaks, we tend to rage on the Fed. So usually
Yeah.
it goes a little bit longer, but 12 to 15 is the goal.
Okay, I love this. This is fantastic. People will be
Awesome.
excited about that. Thank you.